Imagine dumping millions of dollars in Bitcoin, not because you are panicking over threats of a global war, but just so you can buy back your own company's stock.
Yeah, it sounds a bit crazy on the surface.
Right. Well, our mission today is a deep dive into how sudden geopolitical whiplash is forcing corporate treasuries and global regulators to completely tear up their old playbooks. Okay, let's unpack this because yesterday was just wild.
It really was.
I mean, Bitcoin tanked down to around $62,000 on those U.S.-Iran military threats and then instantly snapped back near $64,000 when that multi-nation peace deal hit the wire. It is like institutional trading algorithms are treating Bitcoin as this hypersensitive global seismograph.
Yeah, it really is behaving as a classic high beta risk asset right now. I mean, its price swings are exaggerating the broader macroeconomic movements based purely on global headlines.
Just reacting to everything instantly.
Exactly. And that intense, unpredictable volatility is exactly why corporate treasuries are abandoning that old strategy of just blindly accumulating coins. They have to prioritize balance sheet survival over everything else.
Survival, right. Wait. Let's look at Nakamoto Inc. for a second. They just liquidated roughly $48 million in Bitcoin to pay off debt to Kraken.
Right, I think it's about 600 BTC.
Yeah, and that move lowered their interest rate to around 8% and basically bought them insurance against a margin call if the price drops to that $60,000 floor. But then they used their leftover capital for a $25 million stock buyback instead of stacking more sats. Isn't that a massive betrayal of the whole corporate diamond hands never sell philosophy?
Well, what's fascinating here is that it is less about weak hands and more about evolution. I mean, just sitting on a static pile of Bitcoin, it isn't capital efficient anymore.
Right.
Institutions are realizing they need to actually engineer yield. They are putting the asset to work instead of just sitting on it.
So walk me through that. How do they engineer yield without just selling it off?
Take Japan's Metaplanet as an example. They didn't just buy more spot Bitcoin. They bought a licensed brokerage for about $13.11 million.
Oh, wow. Why a brokerage?
Because they want to issue Bitcoin-linked bonds. They are aiming to tap into its $7.4 trillion of low-yield cash just sitting in Japanese book deposits.
That is a massive pool of capital.
It is huge. And they are generating yield products without even touching their core holdings. We saw Falcon Edge do something similar recently, too.
Oh, yeah. They generated, what, nearly 1% of yield in May?
Right, a 0.861% yield in a single month by actively managing their treasury. And they did it without spending any new fiat capital.
So they are building these complex yield-generating ecosystems.
Mm-hmm.
But none of that works if governments are actively trying to outlaw the space, which I guess explains why we are seeing governments realize aggressive bans actually hurt them. I mean, look at Hungary.
Yeah, Hungary is the perfect case study here. Under their 2025 laws, you could face an 8-year prison sentence just for running an unlicensed crypto service.
Which is incredibly harsh.
Extremely. But now they are entirely dismantling those penalties.
Because draconian bans backfire.
Right. Pushing the market underground doesn't stop the trading. It just blinds the state to the capital flows and completely wipes out their local tax revenue.
Yeah, that makes sense.
So now they are decriminalizing and aligning with the EU's MiCA framework. They are essentially plugging into a standardized continent-wide rulebook so they can actually monitor the ecosystem instead of isolating themselves.
And speaking of monitoring capital flows, the data on illicit finance right now is staggering. A massive 84% of all illicit crypto volume.
Which is like $103 billion, yeah.
Right, $103 billion in 2025. And it is now flowing through fiat-pegged stablecoins. North Korean cyber units, offshore exchanges, they are all migrating. I mean, think of Bitcoin's transparent blockchain like a brightly lit room with security cameras. Every transaction is permanently public.
Exactly, and illicit actors are fleeing that room.
Yeah, opting instead for the shadows of offshore stablecoins, where fragmented jurisdictions simply don't enforce anti-money laundering laws.
The structural risks have definitively shifted. I mean, the intense surveillance capabilities built around Bitcoin have made it practically unusable for large-scale criminal networks.
Because they want the stability of the U.S. dollar without the glaring spotlight of a public ledger.
Exactly.
So with treasuries pivoting to yield and illicit money fleeing to stablecoins, where does this leave the market today?
Well, the current stabilization is incredibly fragile. Analysts at Bitwise are warning of a potential max pain bottom down around $48,000.
Ooh, 48K.
Yeah, that is the critical price point where long-term holders would start seeing serious losses and potentially panic sell.
And Galaxy's models are even more cautious, right?
Right, they are targeting a capitulation band down in the low 40s, like 40 to 46K. It is a precarious moment. If you are managing a portfolio right now, you have to factor in how broader liquidity events might impact things.
Like today's SpaceX IPO.
Exactly, that could suck capital right out of risk assets across the board.
Well, the seismograph is definitely still vibrating, and the corporate diamond hands have certainly turned into yield engineers. Here's a final thought for you to mull over. If stablecoins have fully replaced Bitcoin as the preferred vehicle for illicit finance, fleeing that brightly lit room for the shadows, how long? Until global regulators pivot their crosshairs entirely away from Bitcoin and aim directly at fiat-pegged assets.